Welcome to Market Week in Review for the week ending May 31st, 2019. I'm Sophie Antel-Gibert, and I'm joined today by our senior investment strategist, Paul Eitelman. Good morning, Paul.
Hey, Sophie.
It's good to see you.
Yeah, thanks.
So I'm hoping that we can pick your brain on three topics today. I'd like to start in the equity markets. There's been some interesting movements there. Then maybe moving on to bond yields, which had some interesting developments this week. And then lastly, I'd love to get your update on what our recession outlook is and if the first two topics have had any implications and any changes for that recession outlook.
Sure.
Sound good?
Yep.
All right. So starting with markets, certainly on the equity side, there was some volatility this week. What was behind that?
We had some downside volatility. Equity markets got hit by sort of a string of negative news this week. Just in terms of economic growth rates, probably not the most important development, but some numbers out of China for the month of May were a little bit softer. Their sort of national purchasing manager index slowed a little bit sequentially. So a little bit of a modest concern there. I think the more important developments, though, continue to be on the trade war front. And maybe the biggest surprise was a new front on the trade war with yesterday President Trump actually announcing sort of a sequence of measures to impose tariffs on all U.S. imports from Mexico. That was a pretty big surprise to us, and I think most people. Yeah,
what a way to end the day yesterday, right?
It was certainly a very interesting development. And it's important, too, particularly for the United States, because we talk a lot about how large and dominant China is in the global economy. And while China is the biggest import market for the United States, Mexico is the second biggest. And so now we're potentially imposing tariffs and duties on two of our largest trading partners. And I think that's a significant risk and source of uncertainty for the business community. And we've been talking a lot about the threat of a hit to business confidence, and it's getting more and more likely that that is likely to play out here over sort of the latter part of Q2 and going into the third quarter as well. So I think some downside risks and clouds of uncertainty there, just in terms of the forward-looking trajectory in the United States and globally here as these trade tensions continue to escalate. The news with China as well was not particularly positive either. So with a lot of the escalation on the U.S. side, China is now making some news as well with threatening to clamp down on rare earth exports to the United States, which could be damaging to the technology sector, and also talking about an unreliable list of companies similar to the U.S. putting a bit of an export ban on shipments to Huawei. It seems like China's crafting its own variation of that. So a lot of tension and I think uncertainty from trade, which has been sort of damaging confidence around risky assets. So the U.S. market, as measured by the S&P 500, was down almost 2.2% this week, which is a pretty chunky move. And also, as you noted, pretty significant developments in the fixed income market as well. Right.
Now, before we transition to the fixed income markets, you've talked about China and the U.S. and Mexico. What about Europe? There were some developments there, elections over the weekend. Yep. Brexit is obviously still with us. German confidence numbers came out. Can you tell us a little bit about what are your thoughts there at the moment?
So in some ways, slightly different catalysts for concern, but the same overarching message of questions around business confidence levels and the economic trajectory. So the German confidence numbers that you mentioned did dip down a little bit and are at quite subdued levels right now. So I think that's a watch point around CapEx trajectories and economic health in the region that we're going to have to keep looking at over the next couple of months. And so Europe cares about these trade wars, particularly the U.S.-China angle, given the dominance of both of those economies. The other wrinkle for them around Brexit was Theresa May stepping down and sort of greater uncertainty around how long the Brexit negotiations are going to go on for, and maybe a little bit more elevated probabilities of a hard Brexit scenario. So a lot of different interesting dimensions going on, but generally speaking, this cloud of uncertainty right now, which is creating a lot of challenges.
Let's now move on to the bond market.
Sure.
What is happening there?
Yeah, well, a pretty significant move lower in interest rates, I think reflecting this risk aversion. So the 10-year Treasury yield moved down almost in a straight line this week by almost 15 basis points. So the 10-year yield is now at 2.15, 2.17%,
That's a big move.
which is the lowest it's been in over a year now. And so the U.S. Treasury curve is now quite inverted. So the 10-year yield is significantly below the current Fed funds policy rate of 2.4%. So the market's sending a message that the Fed's going to need to cut interest rates, which is something that they normally only do around major turning points in the business cycle. So the fixed income market is at least sending a tone that there are sort of some growth clouds here that we need to take very seriously. So it was a big move in fixed income.
So historically, we've talked about sort of inversion of the yield curve being one of our most reliable predictors of recession.
Yep.
So segueing into recession outlook, what is this week's bond market and certainly the bond yield sort of telling us? Is that changing your view about recession outlook?
Yeah, strictly from a quantitative perspective, focusing on the yield curve and what our models are saying, it is an escalation of risk. So with that 23 basis points of inversion, we typically see those kind of developments about a year ahead of the onset of a recession. So it doesn't mean something is necessarily imminent, but it means heightened risk of that kind of outcome going forward. And our business cycle index model, which maps curve inversions and some of the other U.S. macro data, has picked up a little bit in terms of its recession risk from a 12-month forward probability of slightly less than 30% to a number that's closer to 35% now. So it's picking up a little bit. That's now a little bit beyond our warning thresholds. The counter to that, though, is we know why the fixed income market is acting in this risk-averse direction. It's a lot of this uncertainty that we talked about today around trade policy, and it's not immediately obvious if those tensions and risks will remain in place over the next 12 months or so. We know there's a U.S. election coming up in 2020. There can at least be a rational argument made that the U.S. administration would want to resolve these disputes ahead of the election and have a stronger economy at that time. And so if these sources of risk and uncertainty do dissipate, we'd probably expect the yield curve to uninvert. And so it's a kind of weird circumstance. I think heightened risk, a lot of geopolitical risk and policy watch points that are going to sort of be key catalysts in the year ahead. And then the final point I would make is that historically, for us to be very worried about recessions, we would want to see the Fed actually kind of maintain and have a restrictive monetary policy stance. And it doesn't really look like that's the case right now. It's more of a reaction to this negative shock and external risk than this sort of standard macro drivers that would lead us to be kind of pounding the table and forecasting a recession. So uncertainty, but we're not kind of quite there yet in terms of wanting to really dramatically shift allocations in a risk-averse direction.
Excellent. Well, thank you, Paul. That's all we have time for today, but
Sure.
Thank you for your insights. And thank you for joining us. We'll see you again soon.
Hi, I'm Rob Cittadini from Russell Investments. If you like this video and want to see more like it, please subscribe to our YouTube channel.